Hey everyone, it's Chris from Mulin from the technicaltraders.com. And I want to talk about precious metals today because we all know that it's a form of money and the sound of it is pretty priceless. If you listen, it's got a tone to it, it's got a weight to it. When you hold these things, precious metals are really they're almost priceless because you never know what's going to happen. In fact, we had the internet go down. Rogers, our internet connection in Canada, which they're Canada wide, and we kind of they almost have a monopoly. When they went down, almost every business shut down in Canada because nobody could process or call anybody or do anything with the internet or cell phones. So it was interesting. I went in town to a cafe, sitting down, and a gentleman came up. He goes, "Hey, Chris, how are you doing?" I had no idea who he was. He happened to be a fund manager. Anyways, he sat down and we talked for about an hour or so. And he said, "You wouldn't believe what happened." He goes, "I just filled my car up with silver rounds." And it was awesome because he's like, "I proved it. I just went to show you that more or less when all hell breaks loose, the internet goes down, you can't buy anything. But if you've got some silver rounds of any sort, or bars or little chunks or whatever, you can change it for something, fuel, food, whatever you need." And it's pretty important. The world here is way more brittle. We're in Canada. I'm in Canada here, but the United States, North America, we are first world. It's a first world problem when something goes down. Or my friend they leaned forward. They got a brand new iPhone and they got a brand new MacBook Air. And my friend leaned forward over his new MacBook and his iPhone fell out of his front pocket, hit the screen of his new MacBook Air and smashed it. Talk about a first world problem. Anyways, my point is this world is brittle that we live in. We think we're all good, but the financial markets, if they break, we've got serious problems. And if you don't have something when you need it, when things go out, you could struggle. We had rain here last October. It rained for like 3 days. Wasn't anything crazy heavy, but it's just steady rain. Anyways, we had flooding. We had our whole street flood out, our basements flood on our entire street. It just goes to show a little rain or one internet provider goes down and the world comes to a screaming halt, at least in Canada. So I think it's important to have some type of physical asset, not something that relies on your phone tapping, credit card, because sometimes that's not going to work. And I'm not a doom and gloomer, but I've always loved the fact that you could barter and exchange something for something else, physical for physical. And this will always have value versus, paper might not have value someday. Right now, the US dollar is killing it in terms of value, but I digress here. So let's jump into the charts. Let's take a look at what's going on with gold because we just had a major breakdown in gold. Let me share my charts. Let's take a look at the charts here. We've got gold. It started a super cycle back in 2021. We had the stars align. Back then, everybody was in technology. Everybody was in real estate. And nobody wanted precious metals. And then the world turned around. Stocks fell, everything crumbled, and precious metals started a super cycle to the upside. Now, we're in this same scenario right now where we're seeing commodities being one of the most undervalued assets. Even though they've had a big rally, they're still the most undervalued by far that has ever been, I think, in history in terms of the SP 500. And we've had that scenario right over here. We started what I think is the next major super cycle in the stock market going higher. Now, we just had gold break down this 1674 area. The quarterly chart is below it. The quarter bar has not finished, so it could recover, but the weekly chart has closed below, and that's a pretty strong indication that we've got a breakdown in gold. Now, it shows here there's about 16% downside potential to the next major support level, which is right across these tops, the stage one basing formation where it traded sideways, went nowhere for several years. So there's quite a bit of downside potential. Now, what's interesting is if we were to take a look at this downside potential in gold and just see how much that will be from the recent highs, it's about a 34% correction. Now, if we were to go back over here, we've got a couple things I want to show you. First off, we had the new super cycle start back in 2001. Very similar scenario we have right here. Then the stock market took off and rallied, and we had a bear market in the economy. We saw the stock market correct huge. The price of gold corrected 34%. And look we've had a super cycle. We're having a bear market in equities. And I still think there's lots more room to go. And I think we could see gold reach down to that support level. It would be another 34%, just like we saw before. So in the grand scheme of things, what is unfolding is nearly identical to what happened in the past. Now, $300 drop in gold may seem like a lot of money, but it's 34%, same as what happened before. From a percentage standpoint, it's all the same. So that's what is kind of interesting there. So let me share with you kind of the stage of where we are kind of in gold right now. Gold to me is equivalent to breaking this green low right over here. It's about to start that decline phase that could last several months. And I think precious metals are going to have a very big rally. They are probably going to be one of the strongest sectors and run for many, many years after it has this cleanse, just like we saw in 2009. Where gold stocks just rocketed higher to 2011, 2012 highs. But we are entering a stage 4 decline. This is a very bearish stage. And that means we're going to see a lot of assets in this area fall. So if we were to take a look over at the gold miners, this is the GDX. If we were to take just the basic technical analysis here, you take the volatility of this topping phase, the height of it from the breakdown area to the top, and copy it and paste it below, which is this red box here, then you can see the downside potential. And it just happens to be the same low we saw in 2015. So we got quite a ways to fall. As you can see, that's about 44% lower on the large caps. If this is the juniors or silver stocks, they're going to fall percentage-wise, potentially a lot more than that. But this just gives you an idea that we could see the large caps in general come back down to a major support zone. And there's a lot more room. The prices could still be halved from here, and then it could build a new base and then start a new major super cycle going forward. So one of the big catalysts for this, one of them, I think there's many, but if we take a look at the quarterly chart of the US dollar index, if we use Fibonacci extension, which is one of my favorite tools, if we take the low, measure to the recent rally, and then the pullback, well, this bull flag uses the Fibonacci to tell us where the upside potential is, which is 121 going forward, which happens to be the previous high back in 2001, where the old super cycle for precious metals started, and then it just ripped higher for another 8 years after that, or 7 years after that. So I think there's more upside potential in the dollar. I think it could spend some time up here, probably another 3 or 4 bars once it gets up here. If you notice over here, there's 1, 2, 3, 4 bars before it broke down. Each bar is 3 months. This is the quarterly chart. So we're looking at another, year and change before the dollar tops, before metals bottom. And I think the new catalyst, the new big move in precious metals takes off. I think it's this reset up to this level with the dollar. I think there's a lot of unwinding in the dollar after that. And that means precious metals are going to go through the roof. But it's still, they could still have a big haircut from where we are. So it's a little early to be jumping the gun and getting excited just yet. Now, when we get into that type of scenario, when the stock market is moving lower, when the precious metal sector is moving lower, you kind of want to focus on assets that are rising in value, or you want to sidestep the market altogether. So the last time we saw precious metals start their correction in 2012, and the last time we saw a bear market, you need to understand that you need to move away from risk. And so this green area down here, this is when gold started the breakdown. 2013, it broke down, and then it continued to sell off in a big way until early 2016. And what this shows here is this is a strategy saying, okay, back then I was the gold and oil guy because gold and oil were on fire. They were the assets to trade and invest with. Of course, once they break down, I'm not a fan of trading something falling or going sideways. I'd rather move somewhere else where there's money being made and where things are trending higher. And so that's what this strategy is. This strategy focuses on trading the indexes, both long and inverse. It looks at owning bonds if they're favorable, looks at moving to the US dollar index, the long or the inverse dollar. So it doesn't matter which way the dollar is actually moving, we can benefit from a rising ETF from it. Or if nothing is lining up and giving us a low risk opportunity, we move to cash and we just sit on the sidelines until there is an opportunity. And the key here, this is called the consistent growth strategy. The CGS strategy is focusing on just being able to consistently get in the market when something is trending higher and it follows the trend. When the technicals say, hey, this trend has reversed, it's time to get out, the strategy gets out. It looks to the next asset class to see which one is moving up and where to put its money. And there's a hierarchy of the positions. We always want to go in the stock market first. It's the best opportunity for growth. If stocks are not favorable, then we move to bonds. If bonds aren't favorable, we move to a dollar ETF, a dollar index ETF. If not, then we move to cash. And by being able to move around the markets and be invested in whichever one is moving higher, it allows us to just grind out these returns, which, believe it or not, they're very consistent, but they're actually way above the average returns in the long run. And the volatility is low. The biggest drawdown we've had since 2008 with the strategy is just about 6%, not even 6%. So, you look at bonds this year, bonds are down. Well, the stock market's down 22% this year. Bonds are down over 42% from the COVID peak in bond pricing. So it just goes to show there's a huge difference. The stock market crashed about 53% during the 2008 stock market crash. And of course, this strategy only was drawing down about less than 6%. So it's all about protecting, preserving capital. And if we can make some money, we are going to try to make some money. But don't get caught up thinking you should be making a ton of money right now and being aggressive. You should be doing the opposite and stepping back. So hopefully that gives you a little bit of insight as to what we're doing here, my focus on the markets. There will be a time when precious metals are going to become one of my favorite sectors. I'm going to be talking about them all the time. We're going to be trading stocks and ETFs and playing all around that sector. But I still think we're potentially a year away before it becomes something that I'm very excited about and heavily involved in. Until then, I like precious metals. I like physical metals, and I like to just accumulate them a little bit each year, just like it's an insurance plan, like buying home insurance. It's really just buying in case there is some crazy collapse, which I hope and don't expect to ever happen. But it's nice to have a physical asset on hand and to build a little bit of a store of it in case we ever need it. Anyways, I'm Christopher Mullen from the technicaltraders.com, and that's it for today.